Good afternoon, everybody.
Good
How
afternoon.
is how are you all
Good
doing
afternoon.
today?
Wow. So just like the morning show, only I didn't have to get up at 4 to come to this one. I was already up.
Right? Yeah, a little bit different time change, a little bit different
So I
subject
love
matter.
Big Bad Bill, man. He's got his coat and his scarf or whatever, his hat on. He's behind him. He's got palm trees and ocean.
Yeah. Yeah. We actually warmed up and got rain today, so it's a little
Nice.
dreary out. But
We're
well,
we're clear, but we got freaking wind at 50 miles an hour and 28 degrees. So
I got rained out in Chicago also.
oh no, but
Yeah,
rain's better than snow and ice.
it sure is. The temperature is right.
Good. All right, I'm going to turn it over to Professor Trent, preserve, protect, and grow Grinkmeyer.
yeah, so we have been getting, or at least I've been getting a lot of questions about where do I start? Where do I start my investment journey? How do I use the information that Best of US Investors uses? And I thought I would hit upon asset allocation. It is one of those subjects that I think most people look at, and it's the typical 60-40 split, 60% equities and 40% bonds. And at one time, that was a really effective strategy, probably about 40, 50 years ago. Um, and then times have changed, and we've all seen the world of investing change. We've seen more complex investment strategies have come about, and I wanted to hit upon how asset allocation sort of fits into the world we live in today and give you a couple ideas. And so the agenda is I'm going to hit upon just sort of the foundation of what asset allocation is. I'm going to share with you four different companies that you all know of and how they approach the asset allocation game and the differences between them. And then Mark is going to hit upon risk management strategies using technical analysis. Some of it may be stuff you're familiar with, but we want to look at this more from a long-term, intermediate to long-term perspective. And then I'm going to share with you the two different core satellite models that I've created using a different approach to asset allocation. And share that with you, share the philosophies behind them, and then we're going to open up for question and answer. And question and answer could be about asset allocation, that kind of thing, or if you're having other like questions about some of the other services we're offering or technical issues, I can help you out with that as well. But this is something we want to do more often. We want to explore different concepts, ideas when it comes to investing. And honestly, I think we're at a point in time where risk management is really going to be critical. If you all have been with us for a while, you know Mark and I are very much on the risk management element. Kerry is on the fundamental analysis. He's very focused on a very individual sector. And I want to broaden this out because I think we're headed into maybe a stormy season the first half of 2026. And I want to give you some ideas of how you can manage that risk. So I'll get this going here. I even have a slide presentation, so bear with me.
And there will be a test afterwards, so you guys get ready.
No,
And some homework assignments, I think, also is what Trent was saying.
yeah, hold on a second.
Do we get credits for this?
You can,
Yeah,
yeah.
I'll be signing your credits
Yeah.
That'll be good.
afterwards.
What,
That'll
what
be
can I
Okay.
very
use
good.
them against?
You get GPUs or TPUs, I think.
Can we get some Bitcoin for our credit?
No, you don't like Bitcoin.
Now you're
Mark
pushing it, buddy.
Mark is fun. Mark is funnier in the afternoons.
Thank you. I'm more awake.
He's
That's
had a
awesome.
few
Thank you.
beers already.
All right. So, okay. Never done a PowerPoint on Zoom, so bear with me. So, um, three to four different companies: Bridgewater, Citadel, Vanguard, and Fidelity. These are companies that I have followed for years, probably for the last 20, 25 years. And um, they all have different approaches to the risk management game, the asset management game. And so Bridgewater is well known because of Ray Dalio. He is a runs a big macro, or used to run, started Bridgewater. It's focused on economic macro events, and he positions that way. Citadel was started by Ken Griffin out of his dorm room at Harvard, and he is more quantitative, multi-strategy approach. Citadel is also one of the biggest market makers in the world as well. Vanguard started out, or is a passive income mutual fund company. We all know them for their low cost passive mutual fund approach. And then Fidelity, of course, is all over the place with asset management as well. So I wanted to hit upon these as each one of them. Bridgewater is a all-weather philosophy, which means they are looking at a risk return or return on risk ratio. So they're very focused on more economic kind of events. So, for instance, there are four economic environments. There's rising growth, rising inflation, falling growth, and falling inflation. And they take the approach of equal 25% allocation to each category, but they then make shifts based on leverage to each category based on the direction they see it going. So if they see rising growth, they'll overweight that category by increasing their leverage or borrowed money margin in that area, and they will actually add a little bit more oomph to the portfolio. If it's a rising inflation environment, they'll reallocate a lot of those margin dollars towards that direction. The interesting thing about this is Ray Dalio in the last, or this fund in particular, has had a 10-year return of 4.9% on average. Now, most people on this call will say, well, that sucks. That's no good. I don't want that. But you have to understand what their purpose is and what their motive at Bridgewater is. And I think that it really determines what your asset allocation or your motive when it comes to investing. They're hired more by pension funds, insurance companies, endowments, many big asset manager firms that only need to get a 6 to 8% annual return. And they want to have a very low level of risk. So they go to Bridgewater and they say, hey, we want to put, 50 million or $500 million with you, but we don't want a high risk level. We don't want to see a negative, say, 10% return or 20% return. We want to keep it real tight, but we want to consistently hit a very tight window of return. And that is determined, that this is where, determining what your risk tolerance is. What are you trying to achieve? In this case, if you were running a pension fund for the state of Alabama or Florida, you can't afford to take a lot of risks. So you go to Bridgewater and say, here's $500 million or $1 billion. We need to hit these target returns. We'll give you a portion of our assets, and then we'll couple that with something that will get us to that 6 to 8% annual return. So that's one way of looking at it from an investment standpoint. Citadel is more of a multi-strategy quantitative approach. They manage about $65 billion in assets under management. And since 1990, when it was started by Ken Griffin, they've averaged a 19.2% return. If you think about the period of time they have averaged that is pretty substantial. That is gone through a number of down crashes, a number of downward markets, but also a number of really high performing markets. The way they approach it, and this is their asset allocation model, they have four divisions. They have an equity division. This is where they use fundamental research and quantitative models. They have a quantitative strategy, which is focused on fixed income, currency, equities, and commodity investments. and they take a very statistical model with predictive analysis approach. Okay. And then you have a fixed income and credit division, which is bonds, mortgage-backed securities, financial derivatives. And they're actually one of the top three US Treasury and swap traders in the world. So, and then you have your commodity section, which is one of the largest alternative investment managers in commodities. Now, they have these four divisions. And then there's this chief investment officer, and then the CEO, Ken Griffin. And they sit down and they look at where we are in the economic environment. And they will overweight or underweight one of these categories. They're always invested in these categories, but they're underweight and overweight based on where they see the best risk adjusted returns. And so when you're looking at an investment process, your core portfolio, this isn't your, swing trading portfolio. This is your like core. This is the portion you hold on for quite a long time. It's your long-term investments. The way Citadel is going about it is they have four categories and they overweight and underweight. Sometimes they take money from equities and they'll put it in commodities, or they'll overweight the fixed income or an underweight quantitative strategy. So it gives you that movement of where things are moving in the economic or in macroeconomics. Vanguard, one of the largest passive income, passive mutual fund investors. They also have ETFs now. Their 60-40 split portfolio, VBAIX, has averaged a 9.7% return over the last 10 years. It's pretty steady. So in their case, they're just buying stocks, and depending on buying stocks within mutual funds or ETFs, they run a target date series. A lot of these you see in your 401k plans, where you have a age-based allocation model. So if I'm 25 and I plan to retire in, was that 30, 40 years? Was that, yeah, 40 years, I would have a more aggressive target date fund, which means more equities and less bonds. And that's all the thing about a lot of these companies is when it comes to Fidelity and Vanguard, they allocate to equities and they allocate to bonds. Nothing really else. So they don't look at precious metals, they don't look at other commodities, they don't look at crypto or anything else. But it's a very, what I call, standard way of investing within that we've all been raised on over the last, in my case, 56 years, is that you just diversify, you hand your money over to a Vanguard or Fidelity, they manage it. And if you get an average of 12% over your lifetime, you're killing it. What they don't take into account are some of the big economic events. What they don't take into account a lot of times is the depreciating or the value of purchasing value of your dollar or your currency that you're invested in. And so when you're looking at these different things, there's three area things to think about. Diversified beats predictive. Being diversified portfolio helps when you have downturns in the market. And recently we've talked a lot about individual stocks that have gone from, up 300-400% this year, and now they've gotten cut in half. And so a process of diversification oftentimes will outrun that predicting a stock movement, that kind of thing. Couple that with active management, you can add value, you can add expertise to it. In this case, Citadel, they've added average 19%. And so what I'm looking at is more of how do we create a core portfolio that protects, preserves our assets, and then we add alpha to it. And alpha is the return over and above the benchmark that your portfolio is given. So if you have a S&P 500 portfolio, and that's your core, your alpha would be the additional average return over and above that. So if historically S&P is up an average over the last 100 years or so about 12%, if you could add alpha and add say 5% more, or 17%, 10%, whatever on top of that, that's your alpha. What I refer to as it's the nitrous oxide that dumps into your engine and makes you take off. And so when I think about investing in asset allocation, I want to preserve what I got. Number two, protect what I have. And number three, I want to grow it. The best way to grow a portfolio is not to lose your portfolio. I've been successful at doing that over my lifetime. And I think this is where we're entering a time where these kind of strategies can help. So, Mark, I'm going to let you hit upon here just a second. Why don't you hit upon the technical side of it? Let me get out of this real quick if I can find it.
Oh,
There we go.
there you go. Mine's pretty simple. I like what you put up there. Keep it simple. And you can do it with anything. And I use what I tell people, and I help run some portfolios for some of my friends and their kids. And the portfolio that we use is very simple. It's the 200-day moving average on an investment. Okay, I don't want them to trade. I don't want them to do anything. They don't have time to trade. They don't have time to understand it, but they do understand the 200-day moving average. And we talk about this all the time. And we've had portfolios up. You can see this is just, the big indexes, the S&P, the Dow, the Qs, the Russells, and the one I like, just the regular ITOT. You can see, since the time we got in where it crossed the 200 and it was confirmed, you see back from May to August, but mostly May, we're up, 16, 11%. And this is less than a half a year, around a half a year. If you put $100 into each one, or about 100 shares of each, you'd be up about $30,000, total. Or you can go in and you can be specific, like just pick the mag stocks if you want to do that. Okay, they might be a little more volatile. Now, these have been up a lot because this has been where the money's at for the last 3 years. So that's why you see these nice returns here. Now, Meta is the only one that we're out of. We talk about that every morning. Still out of it. Okay, hasn't crossed back over with confirmation, but when we got out at 11.82%. Let me see if I can do this. Okay. And see if I can pull this down. And so, no, I didn't do it right. Anyway, didn't practice that one. So I added a different one here, and just sectors. You could go by sectors. We talk about how money flows through sectors. Now, this is the S&P 500 sector. So this is broken up, our S&P 500, our SPY, into 11 sectors. Now, you can play that and move your money around, or you could just keep it in the SPY, which is really easy because you're up 16% since you crossed the 200. Then you can see some of these sectors are not across 16%. So you're actually doing better. There's a few. The XLK, of course, is a technology, and then you've got the communications, and that has a lot of the mags in it too. So again, you'd be up about $10,000 on this one if you went and did the sector one, as opposed to 30,000 if you just did, the indexes. So let me go take a look, and I'm going to show you a chart or two how easy this is. Okay, and then I'm going to get it back to Trent, and then we can talk about this after. Here's the Dow. Okay, this is the daily chart of the Dow, and we've gone back. I just gone back to the beginning of the year basically, and so here's where we would have got in. Okay, and been about June 24th at $430, and this is the 200-day moving average, and you're still in it. Okay, at $480, one trade. All right. And all you got to do is watch it, your daily, if it gets close to the 200, and we've got some charts that look that way. And then you get out with confirmation at the 200. Here's the Qs. Okay. Got in, big pop up. You're looking at the RSI. I look at the MACD, make sure the MACD is going up. I look at the RSI, make sure we're above 50. I can look at volume to determine when I get in. But those are the kind of things you kind of want to back test maybe a couple of days. Because you're looking at long term, and the Qs took off. Okay, and here we are. We're down. We're still here. Okay, once you get in, you don't have to really worry about this anymore. What you worry about is the 200. And as you get closer to the 200, that's when you start using your oscillators again. So here's the the IWM. Oops. IWM. Okay. So here you got in the IWM here. We didn't get a real close here. You stayed in. It didn't fake you out. And you're still in. Here you got in back in this area, probably in here where you got confirmation. You see the crossover, the MACD gives you confirmation along with an RSI above 50. gives you a better probability with volume that you're going to go higher. Okay. And you did. You came back down here and you're like, oh, am I going to get out? But it popped up the next day. You didn't have confirmation. You want it on the downside to come down, retest, and then head down, and then that's where you get out. The other thing that's important when you get in is this up. You want your 200 to be sloping up instead of down. If it's sloping up and you get in here and you have to get out at this level here, and let's say you get out, you're still going to make some percentages on that. If it's sloping down and you get in and then you get out at the 200, you're going to lose money, which is not what we want to do. And I'll show you a few of those here. Here's NVIDIA. If you want to do that, NVIDIA, here you go. You got in here and here's the slope. Okay. So what I like to do is just come in, put a line in, move it to where, and you can see, we were kind of sloping up, it's sideways here, and then it started to slope up here. And as long as that's sloping up, you're probably going to get out with a pretty good price. Even if this came down and we got out here, we're still higher than when we got in. Okay, so that's how that works. So on NVIDIA, Meta, this is the one that we're out. Okay, Meta came over here, got in over here. You got confirmations down here. You took off. Then all of a sudden, you had that earnings or whatever came out and it dropped you right down. You got out in this area. Upsloping, okay? So as upsloping, you got in at the lower end of the slope and you get out at the higher end. And that's how you make your 11, 12%. You wait. We've been waiting. Still nothing yet, okay? No confirmation, no crossover yet. So it's taken us out here at this level. We're missing all this downside. You could put it in a 30-day treasury, whatever you want to do with your money, move it to some other stock. But again, one trade. This is your year. Basically you would have gotten out here, gotten back in here. So basically 2 trades in a year to gain whatever we had, on Meta, 11.82%. Sectors. You can go to sectors too. Let's just do the XLC. Communication sector. Okay, this has a lot of the mags in it. And again, back here in the end of April, after we had a Liberation Day, it came back up, popped back in, and here you go. Look what's going on. You still had that nice run upward and to the right on the 200, which is what you want. You had confirmations down here. You're seeing the MACD go up. You have RSI above the 200 or above the 50 level, and there you go. Some of these, like the XLRE, I don't like to do them as much on these sector ones. I'd just rather have the S&P because you get into these up and downs like this, because the real estate one, it doesn't have all that many stocks in there. So one stock can really make it screw up and down. And that's what you're seeing here. And, it's been a while since we've been over the 200. And then when we get over, it's really not that much. So you're in, out, in. So I don't like doing these as much, but some people have more time. They do these kind of things, and they just rotate from sector to sector. And that's what we talk about. We talk about money flows to where the value is. And by using this, you can see where the value is. You can go over to XLI. Okay, so this is real estate. We see that the money's not in real estate. So let's go over to XLI, which we have on our list. So you can see the money has been in XLI since the beginning of May. We came over here. We retested, came up, retested. You got the 200 sliding up. Here's our line. We'll see which direction we're going. You're up and you're above it and you're still in it. Okay. And that's just a real simple way. You can take anything you want. You can take Kerry's portfolio and do the same thing in Kerry's portfolio. If you wanted to do all those stocks, you can do it in sectors. You can do it by large cap. You can do it by growth, value, large cap, small cap, medium cap. You can do whatever you want and put your portfolio together. And hopefully we'll have some more time in the future. We'll put some of these portfolios together, mock ones, and see how they do. Back to you, Trent. Hopefully I didn't take too much time.
No, you're fine. So I created the bus core satellite models with the idea, and I've been in the business. I started the business as a financial advisor. Kerry brought me in back in 2000. Actually, I got appointed June 13th, 2000. And I had been doing research reports and stuff for him for about a year, and went and got fully licensed. And the thing I learned, or, the thing they teach you, we were with American Express Financial Advisors at the time, now known as Ameriprise Financial, um, is they say just go collect money and go and we'll just run a risk tolerance questionnaire and run a moderate or a conservative, moderate, or aggressive portfolio for them and leave it. Don't do anything else unless they get old, real old. And that's what we were taught. And over time, being the curious person I am and just how I'm made up, I always ask, well, why? Why wouldn't you do it differently? Why are our returns different from, Ray Dalio's returns or Citadel's returns or, Point 72's returns? And as I started to look at it, I saw a different world when it came to investing. And so I've adopted this idea, this belief that investing, the real successful investors look at the weather every day. And when I say weather, I mean the macroeconomic landscape. They look at where money is flowing, where interest rates are, where expansion of money is going, where the contraction of money is going, what currency is doing, and so on and so forth. So I've adopted this idea of looking at things from a rotational standpoint. And with the core satellite models that I've created, you have a base, a foundation, and that's driven by four phases of macroeconomics. I'll share that with you here in a second. And then you have your second story. So imagine the foundation is your basement. Your second level is the alpha. This is where you get the boost. You get the over and above returns. And this is driven by sector driven research, fundamentally driven by evolving future. And this is where tell sheet 12, Kerry's investment philosophy comes into play. And then you protect it through the tactical edge, and that's risk management through technical analysis. And so, come on, there are four phases, economic phases. There's phase one, early cycle. We're coming out of a recovery. So you see the markets, the economy is recovering from a recession. The Fed accommodates with low rates. Think about this going back to the housing crisis. Yeah, this is probably the 2009 to 2013 period. Credit conditions start to heal and high unemployment. You have high unemployment, but improving. And so there are certain sectors that are going to do well, in particular, financials, consumer discretionary, industrials, technology, and materials. And so creating a allocation around that will help you start that movement higher. Your second phase is your mid to late cycle expansion. This is where you've seen sustained economic growth, rising inflation pressure. Sound familiar? Fed tightening cycle, and then yield curve flattening. And there are certain areas that do real well there: energy, technology, industrials, materials in the S&P 500 overall. And then you enter a point in time of stagflation. This is where you have high inflation, slowing growth, Fed hiking aggressively, consumer stress rising, and corporate margins compressing. So and what does well in that phase typically is energy, consumer staples, healthcare, and utilities. And then you hit recessionary environments like economic contraction, rising unemployment, Fed cutting rates, credit stress elevating. And certain things do well there as well. So, for instance, long treasuries, healthcare, consumer staples, utilities, and gold. And so, what I've created is a filter or a model that goes and measures all these different economic events. And so the two portfolios, there are two different ones. There is just a simple sector core tell sheet 12 satellite model. Now, if you're not familiar with the tell sheet 12, it is 12 of Kerry's stock ideas that I've then overlaid a quantitative risk model on top of. And we implemented that back in June 16th, and it has had a pretty awesome performance. But of late, you've seen it starting to decline, and you've started to see it break certain areas. And so, with the core sector tell sheet 12 satellite portfolio, we're only focusing really on just the sectors, not the subsectors, and I'll explain that here in a second. But with sectors, in this case, we're in this phase two environment, and that's where XLE or tech, energy, industrials, materials, and overall broad market of the S&P gives you overall an allocation. And so when I look at this, I go, okay, if this is my core portfolio, depending on my risk, my time frame, how much I can handle in loss, I look at things starting with how much can I lose versus how much I can win. I can allocate anywhere from 40% to 60% to this allocation. And then I want that alpha. I want that boost because maybe I'm wrong. Maybe the market is going to run for another 3 to 4 months, maybe another year. So I want that alpha element to it. And that's where I couple that with the tell sheet 12. Now, you could take that 40 to 60% in the alpha generator and use Kerry's stock ideas and go through his tell sheet and pick his best picks and allocate that way. If you wanted to add a little bit more umph and you were more of a swing trader, you maybe reduce your holding in the alpha section and allocate 5 to 20% depending on your aggressiveness and your willingness to swing trade and add it to that. And I'm going to add that Mark's swing trading element to this portfolio. So it'll be 3 tiers: the core, the satellite, and then a swing trading satellite as well. And so this is a strategy. I look at this and I go, the majority of people who are on this call or who've subscribed to Best of US Investors, they got other things going on in their life, but they need the returns, but they need the risk adjusted returns. And this is a good place to start. It's very simple on the core side, a little bit more complexity on the alpha side. And if you want to swing trade, adds a little bit more complexity there. Now, if you wanted to get a little bit more aggressive, because there would be more volatility in the subsector core portfolio, this is identifying the sectors that I see performing well based on the economic phase that we're in, but looking at the subsectors, in particular the granular side of it, what in those sectors are going to do well as subsectors. And so here you have a little bit more of a bigger core holdings. You've got, in this case, we have aerospace and defense, healthcare, um, was it U.S. Development, industrials, energy. We do have a bond allocation to this portion, financials, materials, and gold in particular, more of a gold trust approach. And so there's a little bit more volatility because we're getting really into the granular side of this. So if you're looking for less volatility, maybe the core sector allocation would be best. But if you're looking for more hyper focus on the core side, in particular in those areas within the phase that we're in, this would be the subsector approach would be a way to go. Now you couple that with the satellite approach, which is I'm using the tell sheet 12 in this case, or you could use Kerry's ideas as well. I don't suggest any more than 12 positions in that alpha generating portion. And the reason is it's a lot to keep up with. And I think with with a humongous big portfolios, it's oftentimes, unless you're spending most of your day looking at these things, it's hard to keep up with them. Now, the thing about these portfolios that you can see here as well, I talk about my intermediate trend and 200-day Tudor-Jones 200-day moving averages. And I put this on here because I'm still risk managing. I'm still using my technical analysis approach that Mark uses that he talked about. And I'm looking at this going, okay, if my alpha side of my portfolio I see is starting to decline, and I have a full allocation to each position of 8% of my, say, 40% allocation to this, then and I see a breakdown like I was seeing actually in AEHR test systems, I would reallocate, I would cut my allocation from an 8% full allocation to 4. So you're still managing the portfolio. As you can see here with was that our holdings, it's broken below the Tudor Jones 200. So a minimum allocation of 1% would be advisable to do. And so you're still active in allocating your portfolio, you're still managing it, but gives you a higher risk adjusted return in the long run. And I know the last 6 months have been fabulous. Last year has been really great. And so, yet Kerry told me this long ago. He says, what goes up will come down. What starts will also end at some point. And I look at this approach of core satellite, and you can help mitigate a lot of risk by just having a core portion of your portfolio and then a satellite portion that can add juice to the overall portfolio and growth to it overall. And so this is the two offerings we have that I'm putting out there. This is not a recommendation or advice, and this will change over time. And as economic phases change, especially with the data coming out from the Fed, or the data that's been delayed from coming out because the stock market or because of the government being closed, we're going to potentially see some phase changes as well. And I would not be surprised if we see more of a stagflation environment in the very near future. And so when I look at how this is, how you can implement this, one, do your research. Two, if this is something of interest, you want to talk further about it, we can definitely talk about that on the Morning Edge or on Kerry's call as well. But also, I think this is a time to start looking at how do you allocate and how are you managing risk. And these two portfolios gives you a jump start to doing that as well. With that said, let's open it up for questions, comments, all that fun stuff. All right.
I like your shirt. That's my comment.
Trent,
What's that?
Yeah, Trent's got his collar on, so I like that.
Yes.
I have a question on your tell sheet. When all
Okay.
three of them, the short term, intermediate term, and long term, are up, is that the time to purchase it and buy into it?
I think when they're all up, you definitely if it's above the intermediate trend line, that to me is a positive. And as long as it's trending higher, where I start to look at it and I go, what is the distance between the trade trend line and the stock price? And a lot of these you've seen just like here's the trade trend line, which is my 15 period moving average, and the stock price is up here, right? Well,
Okay.
to me, at some point it will retreat back towards the trade trend line and most likely retrace back to the intermediate trend line. So it's a reversion to the mean. And so we're starting to see that. If your mean is the 200 Tudor Jones 200, then and it's way up here, that's when you start to be cautious. Um, what I want to see is that it comes, a stock is been near the intermediate trend line, it's within a reasonable distance of it on the top side, and is trending higher. What fuels that is the sector. So is the sector trending higher? Is the economic conditions trending higher? And right now, what I see more on the sector side, for instance, in technology, is you have a contraction in technology. We've had a hell of a run. We've done this vertically. Now we're contracting, and we can see that in a lot of the high flying tech stocks. And so my caution is that if it's trending south and you're breaking that intermediate trend line, it's not that time to buy. If it's trending higher and your sector is trending higher as well, along with the bigger picture, then once you break that intermediate trend line, then start allocating to full allocation. But I think, and that's the thing is what sectors are going to perform well. And that's really what we're trying to do as investors is get ahead of the curve. So where is the money going to flow? And right now, unfortunately, we're starting to see that flow of money out from technology and into more conservative areas. We've seen that in precious metals. Maybe some of that's been manipulated. Mark and I were talking about the silver side of things before the call, but also he hit upon what JP Morgan's been doing with silver here recently. So I would just be what I'm always looking for is where are we in the macroeconomic? What's the weather in that perspective? And then from there, what sectors perform well in those areas? And right now, I see more of the technology side backing off and other sectors going to be, coming to strength. And that's where I'd start dollar cost averaging to it. So hopefully that helps.
Okay. Thanks.
Hey, Bill. You there? I can't hear you.
It's that palm tree in the back.
It's probably windy there.
Yeah, really windy.
All right.
He's
else?
waving. We can't hear you, Bill. We don't know.
Okay, well, I didn't know whether I was on or not.
Now we can
There
hear
you
you.
go.
Now I can hear
All
you.
right.
I've got a stupid question.
You don't have a stupid question.
Which is nothing unusual. And basically, at the start of the program, every morning, you have about 4 or 5, 6 columns up there, which are the various groups of stocks, etc. And I don't know if we're talking about what they ended up yesterday or what they're going to be today.
Oh, on the tell sheet or on
When you start your program on the morning,
When Mark talks
uh
about it in the morning, the different
Oh.
sectors,
you
The
have
charts.
the charts.
That's how it closed the night before. That's how it closed the night before, Bill. And then I have a line where it's going to open.
Okay,
Okay.
thank you.
Yeah. Yeah. So yeah, the market's not open when we start. So it's just I go in and I just throw a line in there where it looks like it's going to open so we can see if it's going to be up or down. And then we look at the oscillators and we look at volume and we talk about it. And a lot of those that we saw, especially the indexes and then the indexes are sideways. The mags are kind of sideways to down, that we've been watching. And then we go through some of the swing trades and such. And I'll start throwing in some of the over and under 200s that I'm watching too, just in case you guys are interested in that. So I think next year, because Trent and I were talking, we think it's going to be a more difficult year than the last 3 years, just because it's hard to go 4 years in a row and at double digit gains. That we're going to look at more portfolio allocations and more risk management also.
So
Thanks, Bill.
one of the questions is I'd like to chat about precious metals. I think it's a good subject to hit upon.
Yeah, I kind of went over silver because this morning, if you were on the call, I think you might have been, Matt, but silver had baffled me because I own physical silver because I inherited physical silver. And then I've got into buying 1 ounce coins, that I like as an investment. And then, I saw silver just kept going and going and gold just kind of didn't. Okay, it went up and it stopped, went sideways, and silver kept going. And that's where I went and I'm like, this is really weird. And that's where I found the story from the Economic Times about what
JP Morgan.
JP Morgan did, where they went out and they had short for 20 years. They were short 200 million ounces and turned it right around. Well, why they were short during this 20 years, holding the price down, manipulating the price like the Hunt brothers did. In fact, they got caught doing it for clients and they had to pay $950 million. I forget how long ago that was in silver. Now they've totally reversed that. And while they were shorting, they were buying. So it kind of reminds me of the Big Short and what they did during the great financial crisis. And now they own physically they own almost half of all the available silver out there, and they moved it out of the COMEX, which is where if you want to get your silver, take delivery of it, that's where it comes from. They moved it into their private vaults, so that's caused a shortage. When India last October tried to get, I think it was 1,000 ounces or something, there wasn't enough, and then we saw issues. And if Mike was here, he could talk about issues in London where they didn't have enough silver to cover what's going on. And so if you have SLV, we went over, that's just a paper silver. Okay. And if you look at the prospectus, it will tell you if markets are in extreme situations, the management has the ability to pay you back whatever they want to pay you back on your silver SLV shares, ETF shares. So silver could be at $300 and they might give you just $60 back per share. Okay. So you don't, what the problem is there's not enough silver, from what I understand, not enough silver to cover what's out there.
I have
silver.
physical silver too. I have a bunch of it that I've been buying over the years. And like, if they're going long, they're expecting it obviously to go a lot higher than it is today.
Because they have the market, they have the supply, and the demand is high. And I was talking to Trent. I said it's like when those guys with Bitcoin take their Bitcoin off, the whales take it off the exchange and put it in their private wallets. That's what they've kind of done with silver.
I think it's one of those things from a longer term perspective. We're entering a phase of, well, I think we're more in a phase of stagflation, because you're starting to see earnings and margins get squeezed. You're starting to see inflation is being questioned. You're seeing lower of interest rates. And I look at, a rotation into precious metals like gold and silver, and maybe the silver thing is a little bit been being played a little bit, but I think you're seeing more central banks are adopting gold. They're buying more of that than they are in treasuries. And so you're starting to see a rotation to safety, in my opinion. They're rotating to things you need. We need gas. We need energy. Certain commodities. We need those things. But yet we got an environment where interest rates are coming down a little bit. And I think you're going to see, I said this earlier today, the first half of this year, after we get a new chairman, federal chairman, you're going to see an aggressive push into lowering the long bond, the yields on that, because that, 10 years attached to your 30-year mortgage, and nobody's buying homes, and you got to jumpstart this economy. So how do you do that? You push down the long bond, you absorb that market, or you become the market, as we're seeing with the 2-year now, and they're $45 billion they're purchasing. But I think there is a lot of fear over here across the pond that people are looking, other countries are looking at us going, I don't know if that's the safest place anymore. So what are they buying? They're buying precious metals. They're buying gold. They're, allocating to that. And so I think that is a step in the right direction from a longer term, that's part of your core portfolio. Allocation wise, 10% starting, depending on where we see this rotation go. But I think you're starting to see that, what was it, 2020? We're in that early stage expansion. Money came down price wise, it became available, and markets took off. Everybody got aggressive, crypto, AI, the whole bit. And then we hit a bump in 2022, and then we took off again with that expansion in tech and all that. But now we're starting to see that pull back. We're seeing that starting to deteriorate in some cases, and that money's moving elsewhere. And precious metals is a prime example of a place that's been going. And I honestly, I would not be surprised gold is a $5,000 an ounce, kind of thing in the next 12 months.
I think silver is definitely being manipulated, and that's just my opinion. But to see what's happened in the last year, and Bob, I don't know what you think about it, but because gold isn't taking off like silver anymore, and then you find out what J.P. Morgan's doing. And then you find out J.P. Morgan also has taken, we talked about the repo. reverse repo and how that's
Yeah.
been drained. Well, JP Morgan took a ton of their money out of the repo,
Yeah.
reinvested in treasury bills because they knew that the interest rate was coming down with the Fed, and they wanted to get a higher interest rate on the treasury bills and took it out. And so that's why, we got to do this 40 billion a month to refill that thing back up because JP Morgan took it out. JP Morgan knows what they're doing. They're not going to be holding the pot when this whole thing falls.
But my feeling is with silver, if they're moving their position to long and they bought a whole load of it, that's telling me, we're bullish. We're going strong on it, and they're manipulating it. That's all right. I'll take the ride. I bought most of my silver below $25 an ounce. So
I think I was looking at research, and I think the same as with J.P. Morgan. They said if J.P. Morgan holds 750 million ounces of gold or silver, which they think they did, that they think the average cost was around $20. Okay, so their unrealized profit at $65 is $33 billion. Okay,
right.
Well, here's the other thing about silver. It's used in manufacturing.
Oh yeah.
So now I mentioned it earlier this morning. I don't know how true this is, but Samson went into a big silver mine and said, "We'll buy it all. We want all of it." And they're gathering it up because if you're using silver in electronics or anything of that sort, that's a commodity. It could become a very
Used in
rare
batteries,
commodity.
Trent.
What's that?
Silver is used in batteries also.
And solar
Yeah.
panels.
So we're seeing more demand from an electronic standpoint, which means demand on those commodities. Um, I mean, that's an area in a stagflation environment that is a strong area. Gold and commodities, gold and the silver element, the different elements like that. So I think we're in that phase change right now to where those things are starting to look good. It's not as sexy. Exxon is not as sexy. A driller is not as sexy as a Meta or a Nvidia, but take into account the weather changes, and when financial weather changes, you should change with it. You should dress accordingly.
Just
Somebody
coming up,
asked,
especially when you see something out of sort like what we're seeing on the silver chart, and then you get news like we had this morning.
yeah,
Something's up.
yeah. Luke asked, "Do you recommend using stop loss for risk management?" I think, yeah. I think I don't recommend it, advise it, blah blah blah, but I do think it is a way to risk manage. Um, and I think having a strategy of using stop losses or trailing stops, figure out if it's a long-term hold, figure out what the average 30-day standard deviation of that stock is, and once you identify that, review it every 30 days, but place your stop just below it so you don't get stopped out. But it would be a way to preserve assets. And maybe you don't put a full 100%, but more maybe, you say, okay, I'll allocate, 25% stop loss at, below, let's say the average standard deviation is 3% daily. Maybe you put it at 7%. And then if you get stopped out, you review your portfolio, you review why it got stopped out. And if you're in a phase change, then maybe it warrants to start reducing that position or tightening that stop up. But I think that's one thing I wish when I was as a financial advisor, we could do. I wish we could have done more of that kind of activity of putting trailing stops on things because one, it would piss people off because you could get, I got a tax event, but on the other hand, when they lose money, they scream at you anyway. So I'd rather them scream at me for preserving capital.
Yeah, I don't think most of those financial advisor firms, tell me if I'm wrong, but the ones I worked with, they don't really care about it. They want to get assets under management. Once they get you in and plug you into the system, they don't care if you ever call them again. They call you again. They're going to go off and try
Yeah.
to find more assets to manage.
Well, and that's I remember
I'm not saying that was you, but I'm saying that you go to any of these
no.
guys and they forget about you, like your insurance guy, you know?
Well, I think you're absolutely right. And depending on the assets you have, a lot of the comments I get about financial advisors is I never hear from them, and especially when things go bad. They're hard to get a hold of. I'm like, well, that's sort of the industry, unfortunately. But I think you do have firms that are very active risk management firms, but a lot of times they're the high, initial assets under management, initial threshold is very high. And they can do that because they have a more specialty practice. But yeah, I do think stop losses, especially no matter what the time frame is, I think it's a great idea. You just have
I
a
do too. I think
process.
that's especially trading too. Yeah, have a process. Yep. I think you'd hear from your financial advisor if you had a margin call. You'd be hearing quite quickly.
Oh, quite quickly. All right, do you think that it will be wise to start researching the vendors of SpaceX? Funny you brought that up. For near future allocation, is China going to keep buying silver and refining it from Peru and Mexico? So on my walk today, I was talking to Grok and I asked, who are the different vendors that SpaceX buys from? Surprisingly enough, they buy from just a handful of companies. ATI, I think it was one of them, but they build all their rockets in-house. Everything they do when it comes to rockets, infrastructure, they actually manufacture it. The carbon fiber that they use, they manufacture it. So SpaceX it's a hard one to to play from a provider standpoint. Here, let me pull this up. It did say, let's see here. ATI is the ticker, still one of the few confirmed material suppliers. They provide titanium and specialty alloys for engines and structure. L3 Harris, LHX, owns what used to be Aerojet Rocket Rocketdyne supplies.
They used to be one of my customers, Aerojet, out of Sacramento.
Okay,
Yep.
so they supply supplies some of the upper stage engines and pollution bits. Not a huge volume for SpaceX, and then STM Microelectronics. STM is the symbol. Big chip supplier for Starlink terminals, stats. If orbital data centers mean way more powerful next gen birds. Da, da, da. And then, of course, they hit upon NVIDIA and Broadcom as well, especially if he can pull off this data center in space thing. Um, he still has to have chips. And the nice thing about Broadcom is they'll custom make them to his liking. So that's something there. I think the second half of the question is China going to keep buying silver, refining it from Peru and Mexico? I I mean they're in the
China
manufacturing game. So
China is the top refiner of silver, and I was just researching it today, and this whole tariff thing, and that might be why they're pulling silver. And under the tariffs, from my understanding, a lot of silver processors send their silver in the raw form to China. They refine it and send it back. Under the tariffs, they won't send it back anymore if you send it, is what I understand. So,
gotcha.
yeah, but he's right.
So
It's Mexico, China, and what was the other one down in South America?
Peru,
Yeah, those are the top producers.
yeah. Kevin posted this here about silver. Samsung has invented a silver battery that can replace lithium totally. I heard someone said Samsung bought a whole silver mine this morning. That's what I was talking about earlier. Um, if they did that, silver will go through the roof, especially if it's a good battery, and it has a long life. Because lithium is the play at this point. Um, blah blah blah. All right, I think that's all the questions there.
Yeah.
Anybody else got anything they want to hit upon?
Well, wow,
Oh,
two Zoom calls in a day, one at the beginning, one at the
I
end.
wanted to tell you before that um, dealing with housing and mortgages, I don't think bringing the mortgage rate down is the only resolution. I think most buyers are concerned about uh, a stable house price because they're all dropping now.
yeah.
Here's another thing I think, Bob, too, is I just researched into this, and like the ratio of income to housing prices is like between 6 and 7 times, and normally it's around 2 to 3 times. And
Right.
so until that salary comes up or the houses come down to hit that ratio, it's going to be hard for people to buy houses.
And they can't afford them.
Right.
So, and mortgage, so, everything's relative, right? So the house, the price of the house is like at numbers that are unaffordable, specifically in the Northeast. They're not coming down in the Northeast, but in Florida, Arizona, Las Vegas, all these areas, the houses are coming down substantially.
You
Um,
know,
until
you know,
that
Bob,
happens, so that correction gets to a stable number, which brings me back to 2015, right? That's when I think people really started to buy homes again because the numbers bottomed out.
I think, Bob, one of the biggest factors they can go in, they can lower, become the market for long bonds, drive yields down. They can pump money into the economy, but if your income does not increase and the cost of inflate and things inflate, which is more of that, phase one element, if your income doesn't increase, you're still not going to buy a house. You're
Right.
still
So
not going to be able to buy.
That goes back to that ratio of
unless
housing price.
unless income increases by 25%, your income, it's a no game, right?
Yep.
People can't afford it. So what we're talking about, there are too many headwinds for people. It's not just one. It's not just the bond. It's the house price. It's affordability. The list goes on, right? And then how many have 6 months of because when you
Cash
get a
reserve.
mortgage, you need to have 6 months of cash in your bank account to pay the mortgage in case you lose your job.
And also, Bob, on top of that, not only is it the price of the house, it's the cost of maintaining it, the cost to insure it, and the cost to pay your property taxes have all gone up too.
Exactly. Yeah.
Yep.
Yeah, because the house prices all went through the roof.
Absolutely.
So
I think that when that's the thing about you think about 2020 and the whole stay-at-home mailbox check, there were more people who never really participated in the stock market and did well, over exceptionally well in the stock market until that period of time, because money was showing up in the mailbox. Everybody was throwing money at the stock market and it went higher. And then everybody went back to work. And then that money quit showing up in the mailbox. And I think if you see another shift like quantitative easing, and you see another phase expansion, kind of thing, certain people are going to do well in the stock market, but the
Asset
rest of
holders.
everybody's going to struggle
Yep.
because they're not getting an income bump. They're not getting that kind of thing. And I think that's the major long-term problem in the United States, is that we got to bring income and cost to some level, even level. We got to even that out. But the system, I mean, to do that means it hurts, very big hurt. And I think that's the biggest. No
Part of
politician will ever get reelected for
yeah.
for resetting the system. And
Part
that,
of part of
unfortunately,
the
is the driver.
part of the affordability also is during COVID when people didn't have to go to work. people moved from high cost areas to low cost areas. You had people on the West Coast moving to Boise, Idaho, and Montana, Black Hills. Here they're buying up farmland. Down to Florida, people moved down to Florida and
Yeah, they're moving
Texas, and
to Ohio now. They're saying they're moving.
yeah, yeah. And so they paid all these high prices, like you saw, Trent. They come down here, and now they're underwater. And people can't buy them because Bob and I and you went when the interest rates went down to 2 to 3%. We refinanced our houses, and we're like, well, I'm not selling my house at 2% to go buy one at
Where are
7%.
you going to get that mortgage again?
A lot of people sold their homes during the COVID when they were shorties on homes,
Yep.
and
Yep.
then they moved into apartments. And then, so when all this broke out, they don't have the money to go back and buy a home because the interest rate didn't change like the way they thought. And all that money that they had left over, the economy didn't go down, so they spent it all. Either you eat or you buy, or you do what?
Yeah, that's a good observation.
What I do
Last
find
thing-
happening. Go
Yeah.
ahead, Bob. Oh, went and got my hair cut yesterday, and I was talking to the
Which
lady.
one?
And huh?
Which
I
one?
was. They're all gone now.
Okay.
So anyhow,
They didn't
and she
polish
told
it.
me
They didn't buff it up.
they just moved from Nashville, and I was like, oh, that's cool. So 4 kids, husband and wife. Um, they came down because they love the beach, the whole bit, but they sold their house in Nashville in 26 days. I was like, wow. And she said, yeah, we came down here, we found a house, had been on the market for over 200 days. And per square foot was cheaper than it was in Nashville. So they were able to buy more house because they have 4 kids, right? And she said, you wouldn't think that would be happening right now, but down here in the Panhandle, prices are falling so much, whereas other areas like Nashville is still prices are still sustaining, and the amount of time houses are on the market is much shorter than they are here. So you're seeing a bit of I think, a rotation of in the housing. There are certain pockets in the country where housing is still strong or stable, but then you have areas like my area where prices are falling because they got really out of whack.
Well, you take up in New Jersey where we have Netflix, Paramount. They're all moving into this area. I just heard someone else the other day, but a house right around the corner sold on a weekend. Okay, there and again, I'm talking 1.2 million, right? That it's selling for, that sold for, and he got full price. So it's not a question up here. It's the question is how long will it be on the market? They don't stay on the market long here. The market is very strong. It depends on the industry that's in your neighborhood. If you have an industry,
Tourism.
right, and tourism is not very strong, right? So it comes and goes. But when you have big production companies come in there, well, that brings a lot of other subcontractors and companies into the area. And now they're all buying up all the houses in the area. So the price of the house around here is not dropping. It's only going up. So
Yeah.
it's really interesting, the dynamics. But what I see down by me in Florida, I'm watching the prices drop. And I would say $1 million house went to 750 already. So
Wow.
yeah. So
John points
I'm
out,
sure you're seeing it too.
yeah, John pointed out in the chat, people weren't buying second homes in Tennessee.
But what they
You
were
think
doing,
about the second home market during the pandemic and up until here recently, this is a second home. Florida is a second home state, right?
yeah.
You look at some of these other places like Nashville where they do have industry, where they do have, zero tax,
Well, they don't
income
have
tax.
income tax. Yeah.
Hey
Yeah, so
guys,
people are flooding.
before I saw Matt wanted to talk about palladium. I mean, I don't own any palladium, but he wanted to talk about that before, just so you know.
Okay.
I
So
don't know anything about palladium, but
PAL,
palladium's come up.
Why?
It's just commodities. Usually, in times of trouble, commodities usually excel. Here's palladium's chart, PALL.
Look at that.
Yeah. Got to kind of watch the volume. It's a little on the low side, 400,000 back in this area. It's picking up a little, 5 times outside the Bollinger Band, which is a strikeout for me. It should be pulling back in at some point, but it's
Hey,
where it's at.
Mark, look at a weekly chart of it going back to 2015.
Okay.
This is telling.
Yeah, look at that.
Look at the period of time it performed the best.
When was it bad?
This is 2021.
2022, 2021.
Yeah, this is back
2020.
during. Yeah, this was COVID.
Look at
Yeah.
basically from 2019 to
Right in.
it'd go down to 200, which would be October of 22.
Here's 2019, right in this area.
Yeah. So if you look at the economic conditions at that point, what was happening? We were first being introduced to some sickness coming out of China. You had, all of a sudden that's a commodity, major demand, a rush to that commodity. And look at the move it made through 22. And now look at where it is today. You have to go, okay, are we in another move higher? Could we see another $100, per share on PALL? Quite possibly, just because of the phase change we're in.
This is the Nasdaq here, this blue line. And look how they were kind of coordinated, and then they came down together, and then right in this area, they diverged.
Yeah,
which is crazy. So you would think these two would come back together at some point. That's crazy that they started diverging right in this area. This was 2023.
Huh.
Yeah, you saw the Nasdaq crack up, and you saw palladium come down, and now they're diverging, and this is coming up, and you're seeing the Nasdaq kind of come back down. Interesting. Huh.
Yeah.
I wonder if that's going to continue now. It just broke over the 200, right?
Yeah. 4 days ago?
Yeah,
no, 4 weeks ago.
Yeah, it certainly did.
Yeah.
That's on the weekly. You can see here, and we'll pull it a little closer.
Yeah.
Yeah, here's palladium. It fought it for a while, and on the support side, and then the 9 came up.
The breakout.
Golden cross, and it broke up, and you can see all the oscillators are there too. Yep. So this could be an investable 200 Paul Tudor Jones. Yep. Definitely. Yeah. Well, keep it on your list. It's a little pricey, $153.96 per share. I mean, for a lot of people, that's pricey, but it is what it is.
Yeah. Well, I think it's just another example of where is money rotating to. It's looking for value.
And that was on the weekly chart too, guys. That wasn't daily. So,
yeah, it's a weekly.
Yeah.
All right. Any other questions, comments? Want to hit upon?
I think that's it.
All right. Well, we'll wrap it up there. Thank you all for jumping in on this. Our goal, Mark, Kerry, and I's goal is to continue to bring value to you all. I hope the core satellite approach will pique your interest and make you think about how you're allocating your portfolios as we go into the new year. And, preserve, protect, and you'll grow. And that's really the name of the game. So we'll wrap it up there. You all have a great evening. We'll be back tomorrow morning, 7:30 Central, 8:30 Eastern. And then Kerry will not be on his call, but Mark and I are going to host it. I'm going to hit upon a couple ideas when it comes to alternatives to where money may be flowing for 2026 based on the economic phase detector that I've got built here, and put some ideas out there, as well as discuss a couple different elements you all want to get into. And we'll go from there. And that will be at 3 Central, 4 Eastern. And have a great evening. Thank you again. Take care. Y'all live
Good
loud.
show today, boys. Thanks a lot.
Thanks.
Thank
Thanks for
you.
everyone participating. It was awesome.
Yeah. Y'all take care. See ya.
See you guys.